If your car loan repayment looks suspiciously low, there's a very good chance that you may have something called a balloon payment hiding at the end of it. And today I'm going to show you what that actually means when it comes to the dollars, when it's actually a smart way to finance a car, and when it can possibly turn into a trap, leaving you out thousands of dollars at the end of your loan term. All right, so let's get started with something really simple. The definition in simple terms of what a balloon payment is. Instead of you paying your loan all the way down to zero, owing nothing at the end of the loan term, you are left with a large chunk of money still outstanding as part of your very final repayment. And because that large chunk is not included in your regular monthly payment, then that payment is actually a smaller amount than what it otherwise would be if you were to pay the loan all the way down to zero. And in most scenarios, when you hit the end of the loan term, you've got a few options. You can either refinance that residual, so contact the lender that you're using, and hopefully they have some sort of means to actually help you refinance that. You can pay it outright. So if you've got the money saved up and you've been planning all along, then you can actually just pay the residual out and you own the car from there. Or you can sell the car or trade it in and put the proceeds of that towards paying off that residual figure. Now, it sounds simple enough, but here's where it gets interesting. Now, here's where I feel the core problem can come in. And a balloon doesn't really make the car more affordable. At the end of the day, what it does is it actually makes it look more affordable, feel more affordable in the moment, but it's actually pushing the true cost and risk further down the road. But to be clear, like I said, the monthly repayments are lower. So that is a genuine thing. You are in fact paying less every month to drive that vehicle. But what is easy to miss is that although you're paying less per month, the total cost of owning that vehicle and paying it off on finance are still there. And the risk the vehicle ends up being worth less than what you owe is still there also. To show you what that looks like in reality, let's go through some numbers because they tell a far better story than what I can. All right, so let's say we buy a vehicle. It's a $50,000 car. We're going to take out a $50,000 loan for that vehicle. Say we're going to do it over a 4-year term with a 40% balloon or residual at a 9% fixed interest rate. With these terms, the monthly repayment works out about $896. Now, here's a quick running balance over the loan term. At the end of year one, you've paid $10,750 and you're still going to owe $43,477. At the end of year two, $21,517 with a balance of $36,341. At the end of year three, you've paid $32,276 with a balance owing of $28,537. And at the end of year four, you've paid a total of $43,034 and you've got your $20,000 balloon payment that we had at the very beginning. And at that point in time, that money is due in full. Now, here's the number that matters most. 2 years in, you've paid over $21,000 and you still owe $36,341. And now if you needed to sell the car for whatever reason, or to trade and get a different vehicle that suits your family, whether it be a growing family or your situation has changed, then all of a sudden you're going to be left with a car that may not be worth the $36,341 to actually cover the debt. And look, that's before you consider break costs or things that could potentially be charged by your lender. And look, realistically, a $50,000 car, it's not going to be too far away from the $36,300, but it's more likely to be somewhere in that 30 to 33 range for most brands. And that gap that you've got of say $3,000 or $4,000, that money has to come out of your back pocket in a time which could be quite stressful. You may not be prepared for it. You're having to trade the car in or sell the car at a time when is not planned by you. You've been forced to do so. Therefore, you may not have that money available to you. Now, to compare the scenario, I want to show you the same loan, but done with a fully amortized structure. So from $50,000 down to zero across the 4 years. And this time with no balloon, your monthly repayment jumps up to $1,244. Now that's a $347 increase per month. But let's have a look what happens at the same point in time, the 2-year mark, if you had to actually sell that vehicle or urgently get out of it. At this point, you're only going to owe $27,236. That's nearly $9,000 less than the same purchase under a slightly different loan structure at the same time. And let's extrapolate it out to the full 4 years. By the time you get to the end of it, in this particular scenario, your interest on that loan is going to be $9,700 odd. And let's compare that to the loan where we've done the balloon and assuming that they've paid the residual figure out at the end. The interest bill alone on that particular structure is going to be over $13,000. And that alone is over $3,000 more than the structure which is amortized to zero. And that's something a lot of people don't realize. When you take out a loan with this structure, although your monthly repayment is much lower and it feels good at the time, you're actually paying interest on the full amount. And because you're amortizing the loan a lot slower, you're not reducing the principal as quick. Therefore, you're going to pay more interest across the life of the loan. So really, it is a trade-off, and it's certainly not free. You've got a lower repayment now, but a higher balance for longer and a higher interest bill over the life of the loan. And I wanted to give some of my own thoughts here because I do have a lot of experience across the industry itself from sitting in front of people and helping them in these moments. But also, I'm not immune to it myself. I have, in fact, fallen victim to purchasing a car I otherwise probably shouldn't have with the help of residual figures. It feels like it's, great at the time because you're paying so little every month and you're driving this beautiful new car. But in your heart of hearts, you generally know, well, hang on, maybe I should have gone with the lower spec or a different model or a different brand and paid my loan all the way down to nil. And I think over the years, you can see vehicle prices continuing to rise and more crafty ways to finance them are coming out. So people are buying more than what they generally would have in the past. Unfortunately, a lot of this stuff has shone the microscope on the car finance sector, and it's not all bad news. At the end of the day, you can structure loans very well. There's some great ways to do it. You just need to talk with, obviously, people who are in your corner, there to help you out with that sort of thing, and to make sure that you're getting all of the information prior to making that big financial decision. And I want to just quickly touch back on those numbers to help illustrate this. And a lot of people, like I said, trying to buy way out of what their price range should be and drive that car that they really want to drive, but they probably know they can't afford. Let's look at the $50,000 example. What if that person, instead of just getting the $50,000 and leaving the $20,000 at the end, they just went and found a $30,000 vehicle and paid it off over the same 4 years with nothing owing at the end? So you've got essentially a 4-year loan, you've paid it out, and you don't have to pay any money at the end of the term. You're not forced to sell it or trade it in, and you own the car. So then it's up to you what you want to do. You can either continue driving it for years to come, or you've got something that if you do decide you want to upgrade into another vehicle, you can trade that car in, and potentially it's going to be worth a decent amount of money that can go towards a deposit for you onto your next car, which might be worth a little bit more this time, and you're paying it down again. So if you really want that new car, that might be a good way to do it, more so than just forcing your way into those upper specs and having that large residual figure and finding yourself on the constant treadmill. Now, I do say that with a big disclaimer that I am in no way providing any advice to any individual. It is all just general in nature and my own thoughts. You have to do what's right for you. And to be fair to the product, it's certainly been around a long time and there are some really great use cases for it, but it needs to be used under the right circumstances for the right people. So what are those circumstances? When do I think it does make sense? Is it always bad? It's certainly not. So let's balance it all out and have a look at some examples where it might be of great use. Now, the first one is if you've got a clear exit plan. So if you only need the car for a certain period of time, 2 years, 3 years, and you know that at the end of that term, the balloon payment is manageable or reasonable for what that car is going to be worth with a good amount of certainty, that could be considered a reasonable way to do it. Another good example is if you are, say, running your own business or you're a self-employed sole trader and cash flow is more important to you than what maybe the total cost of owning that vehicle would be. Let's say you've just started to build the business and cash flow is vital at that point to make sure you can continue to grow it. Or maybe your work's seasonal and you've got obviously a lot of downtime or periods where the cash flow is a lot lower, but there's times throughout the year where you've got a huge amount of income coming in and it's very easy for you to then really sort of service that debt and to pay it down. In these cases, a lower fixed monthly repayment might be far more beneficial to that person because they're able to earn a significant amount more. Their vehicle's probably generating them an income, and it is vital that they have something that allows them to do that without an issue at all. And the other thing is, if you're just planning to finance the vehicle, it's part of a strategy that you're using with your current financial situation. And another good reason would be if your usage genuinely fits a very low kilometer, well-maintained profile or vehicle, like it's a second car or something that's just required for a means to an end, and you don't want it to impact your cash flow too much, but you need it at that point in time, it may fit the profile then, because lower kilometers on the end, well-maintained, is going to generally be worth on the higher end when it comes to having to resell, or if you did have to get out of that car. Therefore, you're less likely to run into the problems that you may with a vehicle incurring a lot of kilometers and a lot of use. On the flip side to that, it can go very wrong if you don't have flexibility at all. If you're doing a huge amount of kilometers, you're using your vehicle for rough work, so say heavy wear and tear, like a trade, which is getting a lot of materials put into it, things like this where your car could be heavily devalued, or if it's a decision you've made purely based on the affordability and you're stretching yourself with that balloon payment, it's the only way you can afford it. Now that can be a recipe for disaster. All right, guys, look, let's close it out now. A balloon payment on your loan, it's not a trick. Yes, it can be confusing. It's something that the everyday person maybe hasn't come across, but it's really just a tool to use. If it's purely been sold to you as an idea to just reduce your repayment, I mean, I think that although it does do that, it's not really the whole story. It's just moving that repayment and that risk down the road to a later time. So although the number looks smaller on the screen, make sure you understand what you're doing. Make sure you ask the right questions and you have all the information on that particular structure and make sure it suits your needs. And not only that, understand the vehicle you're buying, understand the brand. Make sure that it's well thought out, that residual. So some brands, like I said, they're going to hold their value a lot better than others. They might be more suitable for something such as a residual figure. And that's something that you can take into consideration also. And when it comes to making that decision, take these things into account. Don't just decide based on the number on the screen and your emotions of wanting to own the car that you've always dreamt of owning. And that's it. Make sure you've thought it all out, ask the right questions, and drive away with confidence knowing that you've made the right decision. All right, with all that said, guys, hopefully that's shed some light on what can be an otherwise confusing part of borrowing money for a car. And if you have enjoyed the video, make sure to like and subscribe to the channel. And also make sure to check out any of my other stuff. I've got plenty of things on novated leasing, which funnily enough has no option. You must include a balloon on one of those, but that is for another video. Otherwise, guys, that's it. Thanks very much for watching, and I'll see you in the next one.